Hey everybody, Smart Silver Stacker here. Hope you're doing well on this lovely Wednesday afternoon. We've got a lot to talk about in today's video, some very interesting things to cover, but first I want to start off by just taking a look at the 1 month price charts for gold and silver, because both metals, they're not doing much today. Gold up 80 cents, so pretty much flat on the day. But as you can see on the 1 month chart here, it's doing a very good job of holding on to the gains that it has put on over the past several trading sessions. If we go back to November 3rd, so just last week, gold was back down around 1621, and today it has put on almost $100 since that low. And silver, it's pretty much the same story. A small fractional loss today, down 12 cents. But if we look at this 1 month chart for silver, you can see that back on October 14th, the price was down around 18 bucks, getting very close to $18, and now we are up over 21. So a very significant move in both precious metals over the past month, and they're showing remarkable strength in today's trading session, considering that just about everything else seems to be selling off today. We've got the S&P 500, the Dow, the Nasdaq, the Russell 2000, everything in the red. Crude oil down over 2%, and Bitcoin, really the standout today, getting absolutely taken out to the woodshed and just beaten down today. It's down to almost $17,000 per Bitcoin. So a significant loss there over the past couple days. And we're going to talk about that later on in the video. But first off, thanks for tuning into today's video. If you get some value from it and you enjoy it, please do give it a big thumbs up down below. And this video is brought to you by SD Bullion, so don't forget to check them out for great deals on gold and silver. There's a link down in the description. I want to get to this letter that was put out by a Goldman Sachs analyst about an asymmetric payoff in gold, and how Goldman Sachs sees gold potentially soaring 30% when the Fed starts cutting rates. And I mean, honestly, I think that is even a somewhat conservative estimate. I think that the price of gold probably will be moving much higher than that when the Fed does pivot, and silver even more so. We saw that move in silver last Friday of up almost 8%. And I suspect that when the Fed pivots, we're going to see days in silver where it's moving up dollars at a time. But let's take a look at what Goldman Sachs had to say here and what their analyst had to say. Very interesting stuff. First of all, this guy, Mikhail Sprogis, he's the analyst over at Goldman. He wrote that high inflation tends to be extremely bullish for gold when the market questions the central bank's ability to fight it, such as during Burns' tenure in the 1970s. In contrast, high inflation tends to be bearish for gold when the market gives the central bank credit in its ability to reduce it, such as during Volcker's fight on inflation in the early 1980s. Now, real quick, I just want to pause here and leave me a comment down below to let me know how confident you are in the Fed's ability to fight the inflation that we are currently fighting, because my confidence in the Fed's ability to fight this inflation is pretty low, and judging from the price action in gold and silver that we've seen over the past month, it's looking like markets are beginning to doubt their ability to fight that inflation as well. And that's not really any surprise, because the Fed's been at this for a while now, and it seems like inflation is remaining stubbornly high. Now let's talk about what else Mikhail had to say. He references the fact that gold ETFs and speculative positions have been selling off, but then also he references the gold purchases that have been occurring at central banks around the world. And I talked about this World Gold Council report in the video that I put out on Monday about how the past quarter 3 of 2022, central banks have bought more gold than in any other quarter on record. Now, the records only go back to, I think, the year 2000 as far as quarterly records, but also, if you take the first 3 quarters of the year, January through September, there's more buying going on then than in any annual period since 1967. So central banks, as investors are selling off their paper speculative gold, central banks are scooping up the real physical stuff in a very big way. And the Goldman analysis of this situation is that emerging market central bank demand appears to be a reflection of geopolitical trends that have been years in the making versus a one-off spike. And structurally higher emerging market central bank demand creates an asymmetric payoff for gold, as it provides a floor to gold if further ETF liquidation occurs in response to further hawkish Fed surprises. So what they're saying here is that even if investors sell off gold because of a fear of more rate hikes, if they think that other assets are going to yield more, it's very likely that central banks are going to come in and buy up any of that gold that gets sold off. So it's not very likely that the price is going to fall in a significant way, because central banks, as the price has been falling, they've been increasing their purchases significantly, and there's no sign that that trend is ending. And they go on to say that they estimate that gold could rally by 20 to 30%, depending on the degree of Fed cuts, if and when the Fed does pivot. And of course, I think that that is inevitable. It seems like something is going to break in the economy here in very short order, and we're going to talk about some of the signals that the economy is breaking down in a very significant way and some of the signs of that economic meltdown here. But let's talk about inflation real quick, since a lot of this action in gold is predicated on the market's expectations about what's going to happen regarding inflation. Well, we just got some inflation numbers in the Netherlands yesterday. The inflation rate there year over year, 14.3%. In Germany, from a couple weeks ago, we got the most recent number, 11.6% there year over year. And tomorrow, we're going to get the October inflation data here in the US. So that will certainly be an interesting report. And one thing that I think might be very telling here that we could get tomorrow is if the inflation report tomorrow is higher than expected, and we see gold and silver move higher on that news, that may be a sign that the bottoms are in for precious metals. Because one thing that we've seen over the past several months is every time we get inflation data that's higher than expected, typically we'll see gold and silver falling, because what that means is the market is now anticipating that the Fed is going to be more aggressive in their rate hikes and their fight against inflation. But if tomorrow we get a report that's higher than expected and gold and silver move up, that indicates that investors no longer believe that the Fed is going to be capable of fighting inflation. Even if they want to hike more, it means that they think inflation is going to be persistent. And so that will represent a sea change in the views of the market in regards to the Fed and this fight against inflation, which is very important, as that analysis from Goldman Sachs spelled out for us. And while the Fed's rate hikes have not been doing much to fight inflation, they have certainly absolutely been gutting certain portions of the economy. Just take a look at Carvana here. This is an interesting stock to take a look at the 1-year chart of, or actually let's zoom out to the 5-year chart to really get the big picture. And you can see that if we go back to July of last year, this stock was trading around $337 per share. And today it's down to $7.53. And one thing that we've seen collapsing recently as a result of the Fed's rate hikes is the price of used cars. There's all these distortions in the market. First, the price of used cars was sky high. Now it is crashing back down as consumers are getting pinched. And this is a sign that, the economy is not doing well. The consumer is coming under a lot of pressure. And the U.S. economy, one of the fundamental underpinnings of U.S. economic strength and U.S. GDP is consumer spending. So, of course, credit cards now are at a record high. A lot of the spending that we have seen has been financed by debt. And as interest rates are moving up, that cannot be sustained. And so we're going to see more and more problems like this. And let's talk about problems. Look at Bitcoin. Look what's going on with the price of Bitcoin today. It's down to almost $17,000, down about 16% on the day. And this all started with this collapse of the FTX crypto exchange. Now, I'm not a cryptocurrency expert, by any means. I don't really even follow it too closely anymore, because, I view Bitcoin and cryptocurrency generally as just a highly speculative risk asset. I don't view it as the safe haven that a lot of people tout it as. It's certainly not digital gold. It has very little in common with gold. It's not a store of value in the same way. It has no intrinsic real world use case. And I'm not anti-Bitcoin per se. I just view it as extremely speculative. And moves like this show you exactly what the true nature of Bitcoin is. So this FTX token, which was a token that was linked to this exchange, crashed about 80%. This was on liquidity concerns. Investors in this FTX platform were withdrawing about $6 billion worth of assets, and it led to a liquidity squeeze and just a complete downward spiral for these tokens. The exchange was trying to sell off other assets to protect the value of its token, but it didn't work. This guy, SBF, who owns the token, his net worth has declined from something like 16 billion to under 1 billion. And Binance, the world's largest cryptocurrency platform, is now going to buy out this exchange. So a lot of just uncertainty, a lot of roiling in the cryptocurrency markets. You can see it's not just limited to Bitcoin either. The stock price for Coinbase, the world's second largest crypto exchange, getting beaten down as well. This is the 5-day chart. You can see that back on Friday, Coinbase was trading at over $61 per share. Today, down to about 47, just under 47. So a pretty big shellacking there as well. And so, when you're looking for safe havens in today's environment, I would, none of this is financial advice, of course, but I would recommend taking a look at physical, hard, tangible assets, things that have been money for thousands of years, and, avoiding digital tokens. And if you do want to hold some Bitcoin or some crypto, certainly get it off of the exchanges, put it into some kind of either software wallet, or if you have a significant amount, get some cold storage. Just get it into your own custodial holding. Don't allow any of these exchanges like Binance or Coinbase or FTX or any of these places to hold your Bitcoin or your crypto for you, because we've seen time and time again that is a tremendously risky thing to do. And these exchanges have a long history of failing, it seems like, in the crypto space. I mean, I can remember back when, Mt. Gox, the big one, got hacked and tons of people lost a lot of value, and that's going way back. But since that time, there have just been exchange after exchange getting destroyed or hacked, or one way or another facing a liquidity squeeze like this one. Anyway, it's just not advice again, but if you're holding crypto, just don't keep it on the exchange. That seems to be like the wise thing to do. And also, one thing that we're seeing here, speaking of pain, it's not just in the crypto space either. We're seeing layoffs in the tech sector begin to just kind of get out of control. Now, Meta, formerly Facebook, there's Mark Zuckerberg there, he is cutting 11,000 jobs. So huge layoffs in the tech sector here. And it's not just them, of course. We've also got Elon Musk, who just acquired Twitter, laying off 3,700 staffers from that social media giant. The signs are there that the economy is getting very rough. One of the things that the Fed and the administration have been citing for a long time is the strength of the employment market, but it does look like that trend is coming to an end. And all of this portends a move towards a Fed pivot one way or the other. Now, I don't think that the Fed is really going to foreshadow that too much either. I think they're going to maintain the tough talk until something really breaks and they have to come in. It was just a couple weeks before the Bank of England had to unleash their emergency quantitative easing to save their bond market and their pension funds, that Andrew Bailey, the chair of the Bank of England, was talking very tough on inflation, saying that getting down to their inflation target was their number one priority, no ifs, ands, or buts. And then, the bond market there started to collapse and pension funds were at risk. And what did they do? They initiated quantitative easing. It's going to be the same story here in the U.S. with the Federal Reserve. Only difference is going to be that the intervention is going to be much bigger in scope and size, because of course our bond market is quite a bit bigger than that in the UK. So when the debt market here breaks, or whatever it is that breaks, they're going to have to unleash a tremendous flood of liquidity. That leads us to the real problem, of course. I mean, I know we look at this a lot, the US debt clock, but the real problem here with inflation is that there's a tremendous amount of money still being created as a result of fiscal policy, as a result of spending. When the Fed has to go back to accommodative monetary policy, this problem is going to get that much worse. But, I know we just finished up the midterm elections. It looks like we didn't quite get the red wave that some were expecting, although it does look like the Republicans gained some ground. But at the end of the day, don't expect this problem here, this $31.2 trillion, to go away regardless of who ends up winning this election or future elections, because this is not a problem that politicians can really fix. It's not one that central bankers can fix. And the thing about this is, the time to fix this would have been before we accumulated this tremendous level of debt. It's like getting really, really drunk, and then as you're drunk, saying, I'm going to stop drinking. I don't want to have a hangover. I want to avoid it. Well, there's no avoiding that, unfortunately. You can keep drinking more alcohol, or you can stop and deal with the hangover. And that's kind of the choice that we are going to be forced to make here soon. And if history is any guide, the Federal Reserve is going to choose the route of more alcohol, because kicking the can down the road, that is typically the path that central banks choose. And I think that people are starting to wake up to that. And that is why gold and silver are experiencing a rally here, even while other assets like, fake fool's gold like Bitcoin is selling off. So Just my take on things. Let me know what you think in the comments down below about all the topics we touched on in this video. Do you think that there's an asymmetric payoff coming in gold? Because I think that there may be, and probably even more so in silver. So thank you all very much for watching. I really do appreciate each and every one of you who tunes into these videos, who likes, comments, subscribes. I'd love to hear from all of you. Stay safe and happy stacking, everyone. Smart Silver Stacker, out.